Jim, if I can be correct, you're saying that it will get to 15,000, but you're saying this could be 15 or 20 years away.
No, 5 years or less.
5 years or less?
Yes.
Okay, so in the next 5 years, you think or you feel it will go to 15,000 US?
Yes, I would say 2025. So that's even maybe 4 years. But the point being, it'll happen very quickly at the end. It's not a uniform thing. It'll start to go up $1,000 an ounce every couple of weeks toward the end. So you want to get in now so you can participate in that.
Jim, I have another question here. We had Robert Kiyosaki as a guest, and Robert said on this program, somebody is saying that on the GoCo event 12 months ago, that bank shares will drop. Now, since he said that, some of the leading bank shares in Australia has doubled. Who can we believe? This is the question.
Robert Kiyosaki is a good friend and a very strong economic analysis, so I lean his direction. But I'll tell you why specifically. And Greg, it's really important to sort out, because I make forecasts all the time, and I'll make a forecast, and the next day, the opposite will happen, and somebody go, "Well, you're a dope. You did wrong." No, you have to look at short-term, intermediate-term, long-term forecasts. I just gave you a goal forecast, but I specified 4 to 5 years. Most of my forecasts are 6 months. But they're constantly updated. So, but here's the threat to bank shares, not just banks, but also MasterCard and Visa. They could be completely disintermediated and driven out of business by central bank digital currencies. I mean, what's being envisioned right now is, and the Fed is a little behind the curve. China's got a prototype. They're going to really promote it during the Winter Olympics next year. Europe is working on it. The Fed's working on it. They'll probably have something in the next 2 years, but it will get to the point where you'll have an account at the Fed and your dollars will be on a smart card or your smartphone. And when you want to pay somebody else, it'll go right through the Fed ledger. You don't need a bank. Why do you need deposit slips and online banking, withdrawals and all, balance? Why do you need all that? You don't need any of that. Why do you need MasterCard and Visa? You can just have a digital dollar account at the Fed. So that is that would take bank shares to zero. Again, that's not going to happen overnight, but that's coming. And investors are usually the last to know. Stock market's supposed to be forward looking. They don't do a very good job. They look forward, but they usually get it wrong. So here's a case where if you don't understand that central bank digital currencies can disintermediate the entire banking system, that's important that you do grasp that, because that would be fatal for bank shares, MasterCard and Visa.
Well, this is a big comment you're making. I love it. This is breaking news. You're saying that the central bank lead us to Visa, MasterCard. We won't have one anymore. Go on.
Because Visa merchant acquirers charge about 2.5%.
Yeah.
Your bank charges you something, may not be a lot, but there are a lot of fees. It's slow, it's clunky, but we have to have it today because we need to pay for things. But if you have central bank digital currencies, and by the way, those are not cryptocurrencies. Central bank digital currencies are not cryptocurrencies. It's still going to be an Aussie dollar, US dollar, or Japanese yen. It's just going to be in digital form. The message traffic is encrypted, but the ledger is run by the central bank. So who needs a bank?
China will lead the bust, will lead the way to the next crash. Do you believe that?
The world economy, there are all different countries, all different political systems, all different economies. I understand all that. I spend all my waking hours studying it, and I probably dream about it a little bit too. But the point is, so nothing is unlinked from everything else. But China is heading for a fall. I do agree with that. I just explained in my main presentation why U.S. stocks are in a bubble. And so when you're in a bubble, you say, well, okay, what's going to burst the bubble? What's going to change the narrative? What's going to change how people value stocks? Well, it can change internally just because the facts contradict the narrative, and at some point it becomes impossible to ignore it. But there can also be an exogenous shock. So could you have a shock where a crash in China leads to a crash in the United States? Yes, that's very possible. And China they have not successfully generated a consumer economy. They're dependent on exports. Export markets are moving away. To me, the future is in places like Vietnam and India. They're going to be the main beneficiaries of the slowdown in China. U.S. is very rapidly moving its supply chain out of China as fast as we can. Americans like to talk endlessly about the difference between Donald Trump and Joe Biden. Okay, there are some differences, but there's one big area where there are no differences. The Biden administration is continuing the China policies of the Trump administration. Biden has not relieved those tariffs. They have not eased up on Chinese investment in the United States. They have not eased up on Chinese students coming to the United States. China is it's officially, it's atheistic. It has slavery, genocide, atheism, communism. It's like a trifecta. They support their economy with investment, over half of which is wasted, and they do that with debt, and it's utterly corrupt. So nothing's going to happen in the next 30 days because they got to get this anniversary, or 60 days rather. They got to get this anniversary party over for the 100th anniversary of the foundation of the Communist Party of China. But after that, later this year into next year, at a minimum, you'll see a Chinese slowdown. I think that's already baked in the pie. But the question is, does a Chinese slowdown lead to a Chinese crash? And the answer is it might. And if it does, a U.S. crash could be right behind it because the U.S. stock market is equally vulnerable because it's in the bubble.
Australia continues to have a love affair with real estate. And the question that's come through here is Australian real estate continues to boom. How long will this go on, Jim?
I would say two things. You have to distinguish between residential real estate and commercial real estate. Often they're linked. Often residential and commercial go up together and go down together because it's driven by interest rates, cap rates, business cycles, liquidity, and a lot of other factors. That's not true today. You have a disjunction where residential real estate is booming, commercial real estate is suffering. So you can't just say real estate. You have to say housing or buildings. And buildings are have not hit bottom yet. That's too soon. But residential real estate, absolutely red hot. Well, the answer is when. And you've got a very favorable outlook. Low interest rates are going to continue to be low. People are moving out of cities into suburbs and into rural areas. We see the same thing in the United States, by the way. I mean, I'm out here in the country. I'm up in the mountains. Try finding a carpenter, a plumber, a painter. You can't. Even in the cities, which are getting some in-migration from places like New York. You want to renovate an apartment, let's say. The contractors will say, call me next year, or I'll put you on the waiting list for the end of, we're talking 2022. So yeah, it's booming here too. We see it all around us. But there are two risks. One is, do stock markets crash, and does that cause a liquidity crisis? So all of a sudden, real estate crashes along with it because people are losing their jobs and or they're over leveraged, and that would contribute to that. But the other one is, does the economy just slow down? Or another scenario, it could be any one of these, by the way. You don't really have to forecast, you just have to list them and say, use the Bernoulli process. So I don't know which one's going to happen, but what are the odds that one of them happens? Well, that can be a lot higher than the odds of the individual things happening because you got 3 or 4 of them on the list. But the other one's inflation. I'm not forecasting inflation in the short run. I expect disinflation and maybe even some deflation for the remainder of 2021 into 2022. But beyond that, when you get to late 2022 and 2023, yes, inflation could emerge, in which case interest rates are going up, in which case real estate's going down.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
The investment legend Michael Burry, I think that his name. Do you know who Michael Burry is?
Yeah, he was the guy who shorted the real estate market ahead of the mortgage crisis in 2007. He was featured in that movie. I forget the name.
The Big Short.
Yeah, The Big Short.
That's right. He was the guy that they used his profile on The Big Short, and of course, it was a massive win. Now he has come out with 3 new predictions, and it's written in this article over the weekend in the Barefoot Investor, who you won't know who he is, but he's well known here in Australia. Mm-hmm. And the first thing that he said is that and this has already happened to this point, I guess, he shorted himself on Tesla when it rocketed up to by 743%.
Right.
I don't know if he's still short on Tesla, but that's number one. His second prediction was saying he believes that Bitcoin is in a spectacular bubble, And I don't know if that was said before it dropped by 50% just in the last week. So that we've got to take that into account.
I think it was. He said that before the recent 50%.
Yeah, so I think it's already dropped. And thirdly, and he's saying the experiment of printing money is going to lead to hyperinflation and an economic catastrophe worldwide. What are your thoughts? Now, of course, he's saying hyperinflation. You're not saying that.
Not yet. But again, I would distinguish between 2024 and 2021. But let's just take those numbers. First of all, he's two for two. I mean, Tesla did drop and Bitcoin did burst. Now, it doesn't mean Bitcoin won't come back. It probably will. And Tesla's in a world of its own. It's Elon Musk is the greatest showman promoter since P.T. Barnum. But those two things were actually related, because Elon Musk came out and he said two things. He said, number one, Tesla is buying Bitcoin. It bought I forget the exact number, but it might have been upwards of $1 billion equivalent of Bitcoin. Number two, he said that you could buy a Tesla with Bitcoin, that they had made arrangements, and if you wanted to pay for Bitcoin, that was fine. Well, that was, I talked a little bit about, when I was talking about the stock market in my keynote, I was talking about narratives. Well, that narrative dominated the Bitcoin world. I mean, you just look at a Bitcoin price chart, right? And then look at marketplaces where Elon Musk made those statements. It went right up from there. Now, here's the point. What Musk missed is that if you link Tesla to Bitcoin, all of a sudden your stock price doesn't have anything to do with promoting electronic vehicles anymore. It has to do with the price of Bitcoin, because Bitcoin going down was not only going to affect Elon Musk's Bitcoin, it was going to affect the price of his stock. I don't know this for a fact, but my estimate would be that somebody tapped him on the shoulder and said, "Hey, E, do you realize that you've now linked the price of your stock to Bitcoin?" And then he comes out, it was literally just a matter of a few weeks, and says, "You know what, time out, we're not taking Bitcoin for Tesla. You can't buy Tesla with Bitcoin." And he said, "We're not dumping it, but we're not buying any more." And then the price of Bitcoin started to crash immediately. And of course, that took the price of Tesla down, and Michael Burry made a lot of money. But I think Musk failed to understand, but he had a stock that was volatile enough. He was a very good promoter. Every time I see a Tesla driver, in an expensive neighborhood, I see a Tesla, I want to pull the guy over and get my $7,000 back, because we have a $7,000 per vehicle credit in the United States, but I pay taxes to give the other guy a $7,000 credit on his Tesla. So I want my money back. But that aside, so he's a great promoter. I'll give him credit. Whenever you can get the government to subsidize your business, it's pretty much a sure winner. Good for him. But I think inadvertently and mistakenly linked the stock price to Bitcoin. So not only did Barry get it right, but it was a twofer, because when Bitcoin went down, Tesla went down with it, and he made money on both positions. Now, coming to printing money, again, I'll repeat what I said in the keynote. Money printing by itself has nothing to do with inflation. Money printing does not cause inflation. What causes inflation is velocity, the turnover of money. So let's talk about velocity. Velocity is behavioral, it's psychological, it's something the central bank can't control, and it runs on a narrative. And so right now, there are inflationary expectations, but there's not actually any inflation. It's just not showing up in the data. People are saving. Savings rates are sky high. Savings rates, and this is slowing the economy down, because if I make $1, I can spend it or save it, right? Well, the savings rates for 20 years have been averaging between 5 and 8%, with a central tendency around 7%. In the second quarter of 2020, they went up to 33%. Even as late as last summer, the savings rate was over 20%. Then it came down to 13% last November. And I looked at it and said, well, interesting. It went up to 33%, which chugging up, and then it came down to 13%. Does that mean it's going to drop back down into that central tendency around 7? No, it actually went back up. It's back up over 20. So these are historically sky-high savings rates in the United States, but that means people are not spending the money. There's very good data that shows, these government handout checks, every American, they got $600 at the end of last year, they got $1,400 the first week of March, and everyone said, this is going to stimulate the economy. No, the data is very clear. The data shows that 75% of the government handouts are either being saved or used to pay down debt, which economically is the same thing. When I pay down debt, that's not new consumption. I'm just paying off the consumption that already happened, last year or the year before. So it's all going into savings and debt reduction, which is a form of deleveraging. So there's no inflation on the horizon. So here's the question from Michael Burry, and here's the question from monetary economics. The money's there. It's like dry wood, but you need a match. The match is velocity, which is a change in psychology. What's going to cause that? Now here, just to tie it all up with a bow, going back to what I said about in the keynote about Bitcoin will not replace the dollar, but it may destroy the idea of money. And, in 1917, French artist Marcel Duchamp was invited to contribute to an art exhibit. And he went to a plumbing supply store and bought a men's urinal. And he signed it, Armat 1917, and he put it in a horizontal position in the gallery. And everyone was shocked. No, you can't do that. That's not a painting. It's not a sculpture. It's not art. And he was saying to the world, no, art is what the artist says it is. He was the most influential artist of the 20th century because he forever changed the definition of art by saying art is what I say it is. Well, maybe money is what I say it is, or money is what anybody says it is. And this is the real danger of Bitcoin. I don't care if the price goes to 100,000 or 10,000. I don't own any. I'm not going to buy any. And as I say, if you want something, knock yourself out. That's irrelevant. That's content. It's like you're missing the bigger picture. The bigger picture is we are immersed in an electronic environment created by Bitcoin, which destroys the notion of money the same way a urinal destroyed the notion of art. And if you do that, you may lose confidence in all forms of money. And then you'll get the hyperinflation.
Jim, I'm going to ask this question. Of course, you made a quote on our station, on our show, and it was that Bitcoin will disappear and go away forever.
Right.
Still believe?
Yeah, but not for reasons that anyone understands. But I'll explain to the audience why that's true. Again, the list of objections to Bitcoin is a long list. It's harming the environment with CO2 emissions because the electricity needed to generate the mining. It has no use case. You can't spend it. It's not a good store of value. There's a long list of things that are objections to Bitcoin. They're all irrelevant. I mean, I can recite the list. I helped to research the list, but they're all irrelevant. Talk about the price is irrelevant. Blockchain technology has been around since the 1980s. There's nothing new about that. Encryption of the kind they use has been around since the 1970s. There's nothing new about that. There's a lot less there than meets the eye. But the thing with Bitcoin is that, as I just mentioned, it is an immersive, all-encompassing electronic reality. We're the fish and we're in the water, and we don't know what water is. We don't know what Bitcoin's doing to us. What it's doing to us is changing our idea of money. So that's the threat. But here's why Bitcoin will go away, because something else will come along and replace it. People will just get bored with it.
What's its life expectancy?
Well, you don't know. You don't know exactly, but probably sooner than later. I mean, do we still use the Pony Express? Do we still send? When was the last time you sent a telegram? People just get bored with it, or something else will come along and it'll be obsolete.